Now we'll talk about specific business deductions. So startup and organizational costs we'll discuss in Chapter 10. Losses on disposition of property we'll discuss further in Chapter 11, but they're completely and totally deductible. And that occurs when the basis is greater than the sales price, so you have a loss. We'll also talk about business casualty losses. So you're familiar with a casualty loss. There's no limitation on these deductions for businesses. And you're going to deduct the complete loss in the case where the property's worth is zero. The government says that you sold it for the insurance proceeds and you get to deduct the loss. So the loss equals the insurance proceeds minus the adjusted basis. So you can treat the insurance proceeds just like normal proceeds. When you have a partial loss, you deduct an amount equal to the insurance proceeds less the lesser of the decline in fair market value or the adjusted basis. And we've seen this before. In terms of accounting periods, we're going to use for our purposes and assume all taxpayers are calendar year taxpayers. In the real world, it doesn't work that way, but we can kind of skip over that complexity. When it comes to accounting methods, the accounting methods matter because it determines when the business recognizes income and deductions. So we really talk a lot about accrual accounting in financial classes and push how important accrual accounting is. We don't actually cover accrual accounting in this class. So corporations and large businesses use accrual accounting for tax purposes, but it's kind of flipped. So it's tax law accrual accounting is designed to accelerate income and defer deductions because the IRS wants to raise revenue. Okay, so it's the opposite of what financial statement rules are designed to do. Financial statement rules are designed to make sure we really earn the income and be quicker to recognize expenses to have kind of an underlying conservatism principle on our financial statement presentation. And you can imagine that the tax rules have a different purpose. So we focus on the cash method. Most individuals use the cash method, and we're already kind of familiar of when we recognize income from the earlier chapters. We recognize revenue when actually or constructively received. Okay, this also applies when instead of receiving cash, you receive property or services as payment. You have to recognize that as income. In this example, we have on August 1st, Tiger Carving Co. Receives $240,000 for $20,000 per month prepayment to carve a miniature replica of the historic columns. The project will take 12 months. How much should the company recognize under the cash method? And because they're under the cash method, they're going to recognize all $240, and we don't care for tax purposes whether or not they earned it. We're more concerned with the wherewithal to pay. So if they get the money now, that's when they're in the best position to pay the tax. For expenses, the general rule is that you deduct the expenses when paid. And there are two exceptions to this. First is prepaid interest, which we deduct over the life of the loan. There were people who were making false deductions by taking out loans on 12/15, prepaying a bunch of interest, deducting it, and then repaying the loan on 1/2 and getting a bunch of their insurance back. So they were getting this deduction for really nothing. So that's an exception. And then we have expenses that create tangible or intangible assets. We're going to deduct over the life of the asset, and this expense isn't periodic, so it makes sense to deduct it over the life of the asset. The exception to this is the 12-month rule. So prepayments related to intangible assets may be deducted if two things are true. First, the contract period doesn't last more than 1 year, and two, the contract period does not extend beyond the end of the next taxable year. So if you think about our example, we have Dean who prepays 12 months of rent on July 1st. So it's $1,200 per month, and 12 months have been prepaid. The question is, how much rent can Dean deduct in 2018? And the answer is all of it, because it meets these two exceptions. It's only a 1-year rental agreement, and the agreement does not extend beyond the end of the next taxable year. It does go into the next taxable year, but it doesn't extend beyond it, okay? So you can think about like insurance and rent are good examples of things that you might prepay in this fashion. How does our answer change if Dean prepays 14 months of rent in advance? We have to recognize the prepayment over the life of the contract. Okay, so then we would just look at the 6 months that would be 2018 rent, and the 7,200 would be what's deducted in 2018. All right. Kind of a couple of other random examples that you might see. These two requirements that we've seen generally coincide with each other, but not always. So here we have a 12-month contract with a delayed start. So we have a 12-month contract, but in this case, it's going to not start until a few months down the line, and it's going to be a little bit tricky. So the YMCA purchased a new gym equipment for the facility on July 1st, 2018. They paid $24,000 for a 1 year, so it meets the 12-year first requirement, warranty on the equipment. The extended warranty covers the equipment after the initial 18-month warranty expires, so it's a delayed start. The 12 months doesn't start right away. Under the cash method, how much of the cost of the warranty can the YMCA deduct in 2018? First, we'll answer that question, none of it. Although the contract period is 12 months, which meets requirement 1, it doesn't meet requirement 2 because it's going to extend beyond the end of the next taxable year. How does your answer change if the warranty covers a 2-year period starting July 1st, 2018? So no delayed start, but now it's a 2-year period. The YMCA must still capitalize and recognize the deductions on a monthly basis, let's say.